Welcome back to Iron Financial, the only explainer you need to forge a stronger portfolio and cut right through the market weakness. Look, I am your lead analyst, and as you probably know by now, I am absolutely obsessed with the raw numbers. I'm talking about the debt, the margins, and the underlying structural integrity of the businesses we cover. Before we even dive in, make sure you hit that subscribe button so you never miss an opportunity to build a resilient, ironclad portfolio alongside us. So, today we are breaking down a massive, frankly mind-boggling anomaly in the cybersecurity sector. When a true titan of the tech world drops double digits after what looks like completely flawless execution, well, that sends shockwaves through literally every portfolio out there. Today, we're dissecting exactly why that happened.
And hey, I'm the Market Skeptic. I'm here to ask the tough questions on your behalf, right? We need to know, is this just Wall Street hype, or is there real durable construction happening under the hood here? Because today we are looking at CrowdStrike's first quarter fiscal year 2027 earnings report. And honestly, I am thoroughly, completely confused by what I'm seeing on the ticker right now.
Okay, so we have a glaring discrepancy staring us in the face. On one side of the coin, CrowdStrike reports their Q1 FY27 earnings, and they absolutely crush Wall Street's estimates. I mean, they beat them handily. They raise their forward guidance for the rest of the year. They even go ahead and announce a 4-for-1 stock split. By literally all traditional metrics, this is a perfectly good, maybe even exceptional earnings report. Yet, on the other side of the equation, the ticker just bleeds. It drops 11% in the red almost immediately. So what gives? Is this a structural failure in the company's core business, or is this just completely irrational market noise trying to shake out the weak hands?
That is literally the million-dollar question. To figure out if we're looking at a classic value trap or a golden entry point, we have to completely strip away the emotion. We have to look at the raw blueprints. Let's look at how heavy the expectations actually were going into this print.
67%. That is the massive, almost unbelievable run-up in CrowdStrike's stock price over just the single month leading into this earnings call.
Wait, hold on. 67% in 1 month? For a company that already has a market cap approaching $200 billion?
Exactly. Investors weren't just pouring a heavy foundation here. They were building on pure, unadulterated euphoria. Think about it. Adding 67% to a company already valued near $200 billion requires an absolutely astronomical amount of capital. When a stock runs up that fast and that hard, perfection is no longer the end goal. Perfection actually becomes the baseline. Wall Street wasn't just pricing in a good quarter. They were pricing in a flawless, market-altering event. So when you're building a thesis on this post-earnings drop, you have to factor in the sheer weight of this pre-earnings rally. It was essentially a skyscraper built on extremely high hopes. All right, fair enough. Expectations were sky high. But let's look for actual cracks in the armor. Section 1, crushing Q1 expectations. If the stock dropped 11%, the underlying financials must have been bleeding somewhere, right? Let's check the numbers. To answer your question about losing customers or spiraling costs, actually no, not even close. Let's look at the real structural integrity of their quarter. Spoiler alert, they weren't bleeding at all. In fact, they were pouring reinforced concrete. Let's start with the absolutely most critical metric for any subscription-based software company out there, net new ARR, or annual recurring revenue. They delivered a record Q1 net new ARR of $256 million. That is up 32% year over year.
32% growth at their massive scale?
Yes. They didn't just meet Wall Street's guidance, they completely smashed it. Listen, net new ARR means they aren't just retaining old clients. This is $256 million in brand new business and existing customer upsells, perfectly offsetting any churn they might have had. In the software construction business, ARR is your steel beam. It is the reoccurring, completely predictable cash flow that guarantees your building stands tall month after month. Seeing this accelerate proves the fundamental demand for their product is only getting stronger. And a top-line growth? It is just as impenetrable. Total revenue hit $1.39 billion for the quarter. That marks a massive 26% increase from the previous year.
Market Skeptic. Well, it's one thing to grow, but doing it consistently over time is the real test.
Exactly right. And this marks the fourth consecutive quarter of accelerating revenue growth. Adjusted EPS came in at $1.10, which significantly beat analyst forecasts of 97 cents. Net income hit $27.8 million, which is a massive turnaround from a loss in the previous year. They aren't just blindly adding revenue, they are doing it with ruthless operational efficiency. And then, on top of all that, they dropped this structural reinforcement, a 4-for-1 forward stock split.
Okay, but a lot of retail investors get super excited about splits, when structurally, it doesn't actually change the market cap, right? It's literally just slicing the exact same pie into more pieces. Why does this actually matter?
You're right.
It doesn't change the fundamental mathematical valuation, but it is a massive, massive signaling mechanism. A stock split is usually a sign of supreme management confidence. It makes shares more accessible to retail investors and employees, sure, but it also clearly tells Wall Street, hey, we believe our stock is going to keep climbing and we want to broaden our base. You don't split your stock if you think the foundation of your company is crumbling. But if you want to see the real heavy lifting being done here, just look at the profitability metrics. We've got total revenue of $1.39 billion compared to a record $468 million in free cash flow.
Wow, okay, that is a huge chunk of cash left over at the end of the day.
It's a massive 34% free cash flow margin. Their Rule of 40 score, which for those who don't know, simply adds the revenue growth rate and the profit margin together, hit an all-time high of 59. You really need to understand how unbelievably rare a score of 59 is at this specific revenue scale. Most companies see this score degrade rapidly as they cross the $1 billion revenue mark. Hitting 59 is absolute elite territory. It means for every single dollar coming in the door, they are capturing an incredibly high percentage of it as pure, unadulterated cash. The balance sheet here is a fortress.
Okay, I hear you on the numbers. The foundation looks completely solid, but I have to push back here. Section 2, the AI cybersecurity boom. Cybersecurity has so many buzzwords right now, and every company is slapping AI onto their pitch deck. Is this revenue surge just temporary hype?
That is exactly the right question to ask. Let's see how this builds into the product itself, because CrowdStrike is claiming a structural shift in how the entire world views their software. To really understand the product, think of a massive enterprise as a giant apartment complex. In the old days, you just built a huge wall around the complex and crossed your fingers, hoping no one jumped it. Well, CrowdStrike changed the game. They act as the ultimate security agency by placing a highly intelligent watchman, a lightweight software sensor called the Falcon agent, at every single door, every laptop, every cloud workload.
Got it. So it's watching everything from the inside out?
Yes, it catches intruders in real time before the damage is done. And because it's connected in the cloud, if a watchman at door A sees a brand new type of lockpick being used, it instantly updates the watchman at doors B through Z across the entire world. That is their core structural advantage. Which brings us directly to the AI boom, and what management is officially calling the mythos moment.
Market Skeptic. Mythos moment. Sounds a bit dramatic, doesn't it?
Maybe, but it's a real inflection point. Back in April, we saw these incredible new frontier AI models released by companies like Anthropic and OpenAI. Suddenly, large enterprises woke up and realized that deploying these powerful AI agents, which can literally write code, access sensitive files, and make API calls on their own, creates a massive greenfield attack surface. You absolutely cannot deploy AI safely without security built in from the ground up. Cybersecurity went from being a boring risk management checkbox to foundational AI infrastructure. And get this, CrowdStrike was actually selected by both Anthropic and OpenAI from the very start to secure these new models.
Okay, so the CEO, George Kurtz, actually said on the earnings call, "In my career, I have never seen adoption happen this fast." He's talking about their new AIDR product, AI detection and response. Now, as a skeptic, whenever a CEO says they've never seen anything like it, my radar instantly goes off. Is he just hyping up the pipeline to justify that massive valuation?
It's definitely a bold claim, for sure. But here on Iron Financial, we don't just take management at their word. We look at the structural data to back it up.
And let me tell you, the data backs it up completely. Sequential ending AIR growth for ADR was over 250% in a single quarter. They went from 0 to a massive adoption rate in less than 2 quarters, building a fiscal Q2 pipeline of over $50 million just for this one specific module.
Market Skeptic. Look, that is staggering speed for enterprise sales.
Exactly. Building a $50 million pipeline in just 2 quarters for a brand new module is essentially unheard of in enterprise B2B sales, where, sales cycles usually take 9 to 12 months easily. It proves the market opportunity here is structurally massive. Kurtz even stated he sees ADR as a larger market opportunity than traditional endpoint detection simply because there are literally more AI agents and interactions to secure than there are traditional laptops. The demand is compounding rapidly, not decelerating. So, the crucial point is this. The foundational numbers are record-breaking. The cash flow is elite. The AI narrative isn't just hype. So I ask the million-dollar question again. If the construction is this flawless, why did Wall Street tear the stock down? Section 3, the valuation reality check. Lead Analyst, the absolute honest answer to why it dropped 11% comes down to the price tag on the building. The market is ultimately a weighing machine of expectations versus reality. We have the bullish reality on one side. Falcon Flex renewals are super strong, ADR is booming, their next-gen CMS scaling up nicely, but on the other side, we have Wall Street's concerns. And the primary concern is the concept of priced-in perfection.
Meaning the stock was already priced for an absolute miracle?
Precisely. Even the most impenetrable ironclad fortress can look weak to investors if they paid the price for a castle made of solid gold. The management team actually provided somewhat conservative guidance for the upcoming quarters compared to the wildest analyst whispers out there. When your valuation is hovering in the stratosphere, conservative guidance, even if it's just management being prudent about macroeconomic uncertainty and high interest rates, is heavily punished and treated as a severe disappointment. Just look at this data from Raymond James Cyber Insights. It visually proves what happens to premium cybersecurity assets under intense investor scrutiny. Even the highest quality A-plus assets in the entire sector are seeing their enterprise value to revenue multiples compress. For instance, leaders in AI-driven security saw multiples drop from 31.6 times down to 25.7 times, despite having incredibly strong AI positioning.
So it's not that the company is failing, it's just that the market is absolutely refusing to pay the same premium multiple for the revenue they generate.
You hit the nail on the head. In simple terms, multiple compression means the business is still making the exact same amount of money, but Wall Street is suddenly deciding, hey, we are only willing to pay $25 for every dollar of revenue instead of $31. The building didn't shrink, the neighborhood just got cheaper. The broader software sector is experiencing this major contraction right now. Investors want validation of profits at scale, and any fear of AI seat cannibalization or just general market exhaustion can cause these premium valuations to contract rapidly, regardless of the underlying asset quality. And here is the number that makes value investors literally lose sleep. A forward PE ratio of roughly 133 times.
That is a staggering premium. To really put that into perspective for you, the S&P 500 historical average usually hovers around 20 to 25 times forward earnings. Even massive, dominant tech high flyers often trade in the 30s or 40s. But 133 times?
It leaves absolutely zero room for error. When you trade at 133 times forward earnings, you aren't allowed to have a conservative quarter. You aren't allowed to just meet expectations. You have to completely obliterate them. Analysts maintained a hold rating, specifically because this premium already reflects much of the optimistic outlook. The upside is already completely baked into the brickwork. And honestly, we knew this volatility was coming. The options market was pricing in a massive 10.5% swing in the stock price post-earnings. That is significantly higher than their average historical volatility of around 2.7% over the past 4 quarters.
Right, so Wall Street was completely braced for extreme turbulence, regardless of how good the actual earnings beat was. The market makers knew the tension was stretched right to the breaking point. All right, let's bring it all together for the final verdict. Section 4, Opportunity or Value Trap.
We've seen the flawless financials, we've seen the massive AI pipeline, and we've seen the terrifying valuation multiples. Is this post-earnings 11% drop a value trap, where multiples will just keep compressing, or is this a rare opportunity to forge a position in a truly dominant company on a temporary pullback? Well, to answer that, we have to look at how this ecosystem builds long-term value. Are customers locked in, or are they fleeting? CrowdStrike utilizes a go-to-market model called Falcon Flex, which allows customers to commit a budget and use it flexibly across various modules. Right now, nearly 25% of all Flex customers are already reflexing. Market Skeptic? Reflexing? You mean they are expanding their contracts before they even expire? Yes, and it's not just a small bump either. The average ARR uplift on a reflex is 26%. Over 130 customers have reflexed multiple times, with an average uplift of 51% over their initial contracts. This is incredibly powerful because it effectively locks out competitors. Customers are actively engaging in vendor consolidation, becoming deeply structurally tied to the CrowdStrike platform. They aren't leaving. They are literally ripping out legacy vendors and moving their entire security budgets onto CrowdStrike, making this revenue extremely sticky. Furthermore, let's rapidly list the undeniable bullish data points that the initial market panic completely ignored. First, the ghost of the July 2024 outage is officially fading. Costs related to that incident dropped to $18.1 million, down sharply from $39.7 million a year ago. That is pure margin expansion going forward. Second, despite what critics called conservative revenue guidance, management actually raised their full-year net new ARR guidance by more than $50 million. And finally, they have over $2 billion in ending ARR coming just from Next-Gen CM, which is basically their centralized threat dashboard, along with their cloud and identity modules. This is not just endpoint antivirus anymore. It's the entire security nervous system for a modern enterprise. So it really all comes down to this. The business is fundamentally exceptional, but the stock was priced for absolute perfection. When perfection was merely achieved rather than transcended, the stock dropped 11%.
And that is the CrowdStrike paradox. You have to weigh the extremely heavy 133 times valuation multiple against the undeniable structural tailwinds of the AI revolution. Remember, every new AI agent requires security. Every new language model expands the attack surface. And CrowdStrike is actively building the foundational security layer for this entire ecosystem.
It's ultimately up to you to decide if you want to pay the massive premium for the penthouse or wait on the sidelines to see if the whole neighborhood gets cheaper.
Stay focused on the numbers, cut through the market noise, and keep building that ironclad portfolio. Thanks for joining us on today's Explainer. Don't forget to subscribe to Iron Financial, and we'll see you in the next breakdown.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.